Hello and welcome. We're very glad that you guys are joining us here today. We got a brand new deal we're unbelievably excited about that's entering Growth and Income Fund 5. But before we dive into that particular individual transaction, just want to zoom out high level. Let's talk about why we're here for a moment. If you're like most of our investors, you're not just looking for a return on capital, you're looking for capital protection, passive income, and ultimately financial security, right? You're looking for a return on life. So in the next 30 minutes, Kevin and I, we're going to show you how Fund 5, which is reinforced by this deal in particular that we're talking about today, it can help many of you achieve exactly that. If you're newer to Sunrise, just a friendly reminder, we've launched 5 growth and income funds over time, over the past 8 years, and have successfully closed 4 of those funds. In that time, I'm proud to say that we've made 33 consecutive quarters of distributions with no capital calls, zero investor capital loss during that period when, unfortunately, that's not terribly commonplace. Many operators have ultimately struggled. So we're going to show you how we've achieved these results later in the presentation. But just want to tell you up front, again, high level, above everything else, we buy and manage assets for downside protection and solid risk-adjusted returns. So let's go ahead and jump into it here. Today's specific focus is on the Nautica Garage. It's a waterfront parking facility in downtown Boston. Absolutely beautiful facility that we're extremely excited about acquiring inside of our Fund 5. It is a core plus income producing asset located in one of the most supply constrained urban markets in the entire country. Boston is a city that is defined by limited land, by strict zoning, and by high barriers to new development. So we're going to spend much of today's presentation walking through this particular opportunity, how it fits into Fund 5. And since I know that most of you are probably less familiar with parking as an asset class, Kevin's also going to be digging into several different deals that we've done historically in that sector, okay, in parking. We're going to go through 3 particular case studies that are really kind of never before revealed to the public. So we're going to dig really deep in a handful of deals that we've done historically in parking that share some never before seen data. Not surprisingly, if you're familiar with the other parking assets that we've put in our portfolio, you'll know that the Nautica facility, it's already generating really strong revenue, and it's entering Fund 5 at a basis that is a fraction of the intrinsic value of the asset. We often like to say that we like buying light value add deals, but in this particular case, Nautica, it's more of a core plus asset than a value add property. As you see when we kind of go through some of the parking case studies in a few minutes, the emphasis on existing income immediately right out of the gate, it's ideal for the role that parking plays in our portfolio. First, before we dig in, our attorneys always require us to provide a disclosure. It should be noted that this webinar is for educational purposes only. The offering memorandum, legal docs, please review all those in advance of making any respective investment. It'll provide all the respective context necessary to make a prudent investment decision. Over time, we've had a lot of experience speaking with an exceedingly large amount of sophisticated folks, experienced investors like you. And lately, there's been, I'd say, a common thread in those conversations. Folks are skeptical and frustrated with many operators in the real estate sector, in the alternative investment space, after experiencing capital calls, paused distributions, sometimes total loss of capital. Maybe you were in a syndication that didn't perform very well, or maybe the operator took out too much debt, got out in front of their skis from a debt perspective. Maybe they got caught flat-footed by the interest rates increasing in the early 20s, right? Or maybe they made just really aggressive assumptions in their pro forma that just didn't really play out in real life. And if that's you, you're not alone. A lot of those kind of can't miss deals that were promoted a few years ago, they're underwater right now. And that is exactly why we built Fund 5 the way that we did. At Sunrise, we don't just ask what's the upside in the investment. We make it our mission to protect the downside well in advance of ever contemplating the return on investment. We're focusing on the return of investment and protecting the downside. And we've designed Fund 5 for very thoughtful, long-term investors who are looking for capital protection and durable recession-resilient income delivered in a highly tax-efficient manner over the long term. Now, as we mentioned, a moment ago at the outset, we tend to attract investors that are long-term focused, right? Well, we're about 1,000 different individuals have joined our team now, who are in it for the long haul, who are interested in creating legacy wealth, and to whom capital protection, income, and tax efficiency, they matter the most. So we're intentionally not fix and flippers. We're buy and hold investors. We don't like to get in and out of deals quickly based on market timing because we're not comfortable with that kind of risk. My crystal ball is broken. Your crystal ball is broken. We'd say the Fed doesn't even know what they're doing. To be blunt, we like to say that we're investors, we're not speculators. We think in decades, we don't think in months or quarters or even years. We think over the long term. In fact, before we dig in the specifics of Fund 5 and this particular individual transaction, just want to take a step back, do a super high flyover of how we manage capital. How do we allocate capital over at Sunrise? We call it the Sunrise Capital Strategy. It's built on timeless investment principles that were true hundreds of years ago, that are true today, and are going to be true hundreds of years from now. The timeless investment principles of the likes of Warren Buffett, Charlie Munger, Henry Singleton, not speculation, not timing markets, but disciplined ownership of and stewardship of essential use assets that produce real income and grow in value over time. Over the past decade, this approach has really been successful in powering 33 consecutive quarters of on-time, in-full distributions to all of our partners, return capital in every single one of the funds that we manage, and it's created what we like to call perpetual passive income for our partners. Each individual letter of the word capital is one of the 7 pillars behind the Sunrise Capital Strategy. It's an acronym, so we're going to dig into each one of them today. We'll start with C, cash flow first. Real freedom comes from reliable income, durable, predictable, safe, reliable income over long periods of time. Very much like Warren Buffett, buying businesses that generate high quality income producing assets, durable cash flowing businesses like railroad, utilities, housing finance companies, some insurance companies over time. So we focus on buying income producing assets that pay you regardless of the market condition, whether the market is up or down, regardless of the whims of Mr. Market. The second tier, the second pillar in the capital strategy is A, add value. We don't rely on market appreciation. We create it. We need to control our own destiny. Just like Warren Buffett in Berkshire, he improves businesses, any of the businesses that he owns, he brings in a CEO to manage that business effectively, create a flywheel to increase the value of those respective businesses. For that reason, we acquire assets, we enhance communities through professional management, infrastructure upgrades, operational efficiency that increase the NOI. We can directly make an impact on the valuation of the business by adding value ourselves, not worrying about what Mr. Market does. The third pillar is to P, protect the downside. Warren Buffett's, rule number 1 still exists, right? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. We buy below the intrinsic value. We use conservative leverage, and we design every acquisition with multiple layers of margin of safety before we ever look at upside. We buy with a cushion at closing, and we maintain that cushion throughout the entirety of the holding period. We always look at the downside first, protect the downside. We focus first on the return of investment before we ever contemplate the return on investment. Think of every single way in which we could lose all our money and squash those risks. Once we've done that, we then focus on the fourth pillar, which is I, invest, don't speculate. Our favorite holding period is forever. So we focus on income producing assets and driving the intrinsic value of each respective property. We don't focus on short-term trends. So our investors benefit from compounding returns instead of chasing the next deal. The assets that we invest in have the highest CAGR, compounded annual growth rate, out of any respective real estate sector. We're investors, we're not speculators. The demand for the product is massive. There's modest supply, provides exceptionally phenomenal long-term compound interest. We invest, we don't speculate. The next pillar in the structure is to T, be tax efficient, have a tax efficient structure. So we structure every single investment to maximize after-tax cash-on-cash return. We don't let the tax consequences wag the investment dog, but once we found an exceptional investment, we optimize for tax efficiency. We use tools like cost segregation, 100% accelerated bonus depreciation, perpetual ownership, so that a lot of the capital that we generate, the return on equity, comes from cash out refinances that are non-taxable as opposed to capital gains, depreciation, recapture, so you can keep more capital compounding over long periods of time. And if you do all these things, right, you have cash flow first, you add value, you protect the downside, you invest, you don't speculate, you have a tax efficient structure, it provides you with an exceedingly high A, assurance of outcome. Predictability is not luck. This is the highest likelihood assurance of outcome that we could possibly fathom when managing real estate. Predictability isn't luck. It is process. It's designed. Every single fund, every single property, every single quarter, we follow proven systems that produce consistent, measurable results to ultimately ensure that when we make an investment over time, we'll be able to get all those chips off the table and be able to operate on an infinite cash on cash return. This is the highest assurance of outcome that we could possibly fathom in a structure, which allows you to L, the seventh pillar of the strategy. L, leave a legacy that is built to last. Because at the end of the day, the goal is not just about wealth. It's not about just getting another zero on the income statement, another zero on the balance sheet. Building wealth just isn't enough, right? Everyone that is on this call is already, quote unquote, successful in the eyes of society. We have to build more than wealth. We also want to pass along not only wealth, but wisdom to the next generation and allow that compounding to continue over time. We're helping investors build multi-generational portfolios that both preserve capital and values over time. It's wealth that can last long after the individual does. And that's the Sunrise Capital strategy in a nutshell. It's a disciplined Buffett-style approach to essential use real estate. It's how we've built a decade-long track record of consistency, and it's the exact same framework that we're carrying forward in Fund 5. Continuing with the next deal that we're doing, the exceptional deal in Boston, Massachusetts. When you consider the principles of the Sunrise Capital strategy, it's no surprise that we love parking as an asset class. Over the course of the next 20 minutes, we're going to cover a recap of why we love parking. We're going to cover 3 detailed case studies in parking that we really haven't gone in depth on historically. We're going to cover the Nautica deal in depth, and then we're going to give you an update on the Fund 5 assets as they currently sit. You guys are likely familiar with the hosts of this webinar, but for those who are unaware, the principals of the fund are Kevin Bupp and myself, Brian Spear. Kevin's the chief investment officer over here. He heads up the acquisitions team and underwriting side of the house. In a few minutes, I'm going to turn over the mic to Kevin. He's going to talk more about the parking assets we already own, as well as the Nautica deal. He and his family live down here in the Tampa Bay area. I serve as the CEO of Sunrise. It's a vertically integrated organization that was recently honored for being one of the fastest growing companies in the Tampa Bay area, where my family and I also live. Fun fact about me is that I'm a switch hitter. Ultimately, in college, I played baseball, was voted captain of the team by my teammates at the University of Kentucky, where I ultimately received my business degree. At Sunrise, we have over 65 members of our team who manage various different aspects of the business that range from property management, asset management, to operations, to finance, to the investor success team that serves all of our valued partners on a day-to-day basis. Most of you already know this, but just in case, go ahead and check out Kevin's book. It's a bestseller called The Cash Flow Investor. I would also suggest that you head over to the Real Estate Investing for Cash Flow podcast. It's one of the top real estate investing podcasts on the entire platform of the past decade. Literally been downloaded millions of times all over the world, trying to add value to all the listeners along the way. And, as we're talking about parking today, I also felt it would be prudent to share just in passing that I was honored last year by the National Parking Association for the work that Sunrise has done in this particular vertical. Not trying to toot my own horn here, but rather just underlining this as an example of how our commitment to parking is being recognized nationally in this respective industry. So here's why we're so committed to parking. Many of you who know us probably know us as the mobile home park guys, right? We've been investing in mobile home parks for well over a decade, nearly 15 years now. We cut our teeth in that respective asset class, and but we've actually done a number of parking deals within our funds over the last several years. We're now over $100 million in parking transactions. We're in the 9-figure portion of our portfolio is in parking now, and we added parking to the portfolio because of the many different similarities and the synergies that it has between these two asset classes, between mobile home parks and parking. Pictured here is one of the crown jewel parking assets that we own. It's inside of Fund 3, actually. It's a photo of the Lours City Center in downtown Phoenix. This is actually the first deal that we did that was associated with massive downtown entertainment and tourism traffic. As you guys know, real estate, the old adage, it's all about location, location, location. And you're going to be hard pressed to find a better location than this one. The Lours City Center, it's one of our best performing assets in the entire portfolio, regardless of parking, mobile home parks, one of the best assets that we own, period, as Kevin will explain in a moment. It's just a block away from the Phoenix Suns Arena. It's 2 blocks away from Chase Field, the Arizona Diamondbacks Stadium. It's right across the street from Maricopa County Courthouse. And the new Boston deal that we're acquiring is similarly located in a prime spot in the city. And, what's funny from our perspective is that even though these assets are in unbelievably exciting locations, we actually invest in parking not because it's unbelievably exciting, but rather because it is so unbelievably boring. I was on a podcast pretty recently with two really great investors in a completely different space than Sunrise, great guys. And they very bluntly asked me the question, Brian, this podcast was about parking. Why invest in parking? It just seems so boring. And my answer was that boring is beautiful. Many of the greatest investments are extremely boring, and parking. This is one of those investments. Again, most of you guys know us as mobile home park operators, and that's been our core business for over a decade. But we love parking assets because operationally, they behave almost the same. And we like to say that we actually like to operate our mobile home parks like a parking lot. And what I mean by that is they're both cash flowing covered land plays. The income covers your carrying cost today, and the land play suggests that the underlying land value increases over time. They're also very, very straightforward in terms of the operational efficiency of the assets. They're very predictable revenue. Small improvements matter, and you don't really need heroic assumptions in a pro forma to make the numbers work. Both sectors are also highly fragmented, which also lets us buy assets with less competition in the marketplace so that we can buy with a cushion of closing and buy with a real margin of safety. And because the demand for affordable housing and parking, it doesn't disappear in downturns, it actually increases, you tend to get stable cash flow and steady same store NOI growth, which fits perfectly with our long-term buy, refinance, and hold strategy. So parking is not a departure from what we do. It's actually an extension of what we already understand exceptionally well over time. Let's take a look at the macroeconomics. Just zoom out high level and talk about the macroeconomics of parking. As I said a moment ago, the beautiful thing about parking is that it's an exceptional cash flowing covered land play. They say a picture's worth 1,000 words. So we're going to show you two pictures of how this plays out in the real world over time. And the two things that I really want you to focus on are the vast amount of parking lots in the downtown district of Houston in 1978. And then I also want you to take a focus on the black skyscraper on the right side of the screen. And if you fast forward to today, the entire landscape has shifted. You still see the black skyscraper on the right side of the screen, but every single parking lot, nearly every single one of them, has been redeveloped into a higher and better use. The black building on the right side of the screen is still there, but it's no longer alone. And the value of the underlying real estate has risen tremendously over time. And that shrinking supply of parking lot is very, very beneficial for investors in this asset class. Just diving in a little deeper here, the demand for parking is massive and it continues to increase. Parking demand is a function of population growth and transportation habits. And as everybody knows, the population has historically increased and is expected to continue increasing precipitously over the next several decades. We got about 300 million vehicles in the country today, and that's projected to increase significantly over time as well. But what about the supply? Is the supply keeping up with the demand? It is not. In fact, it's actually shrinking. The National Parking Association estimates that there's about 40,000 parking facilities in the country, but census data shows that that number is actually declining. Why? As cities grow denser, the land gets repurposed. And in a downtown core, parking is usually the lowest value zoning, which makes it the first thing to ultimately disappear when redevelopment happens. So over time, demand rises while the number of parking spaces steadily falls. And there's something that just happened in Dallas very recently. It's a change that validates the core of our parking investment thesis. Dallas just eliminated minimum parking requirements citywide. Developers, that means they no longer have to increase parking in new projects, especially in dense downtown urban zones where structured parking is costly and it's unlikely to pencil from the developer's perspective. It's not necessarily a great investment to build more of that. So what does that mean? It caps future supply. And if you combine that capped future supply, artificially constrained supply, with the growing demand from tourism, office space, population growth, you get an inelastic supply environment. There's fewer parking spaces, but more demand, which means you're going to get higher parking rates, stronger NOI, and ultimately rising asset values for owners of assets just like us. And we've seen this play out before. It's not the first time we've seen this in the marketplace. Just look at our Lowe's parking facility in Phoenix, where ultimately Phoenix did the same thing. They removed minimum parking requirements, and a brand new hotel was constructed, newly developed, 400 doors on the same exact city block of the Lowe's parking facility. Now, what happened? The developer chose to build 400 doors because it's more profitable than building brand new parking. They brought no new parking spaces to the marketplace. So all of the parking demand that was generated from the hotel, 400 brand new doors, all of that demand ended up going into our parking facility. There was no new supply coming to the marketplace. So all the brand new folks, tourists, park in our facility. It ended up creating massive NOI growth and millions of dollars of growth on the balance sheet. And ultimately, the same exact thing is playing out in Boston. In December of 2025, the city council put on the docket the idea and the concept of removing parking minimums. The deal that we're talking about today, the Nautica Garage, unbelievably excited. We feel like we've been out in front of this trend. We feel like 15 years ago when we started buying mobile home parks, nobody was bragging about owning mobile home parks around the water cooler. We were out in front of that respective trend. And similarly, we feel as though we're out in front of the trend in parking. It is a nationwide trend of removing parking minimums. It ultimately has occurred in Cambridge, Massachusetts, Minneapolis, Denver, Phoenix, Dallas, and now it's on the docket in Boston. Getting out in front of this trend ultimately ensures that you have exceptionally phenomenal long-term macroeconomic tailwinds in the space. Again, Dallas is just the latest major city to make this move. It is a national trend, and we're ahead of it. So how have we done over the past 8 years at Sunrise, right? Track record of performance. Funds one and two, they were not structured for a perpetual hold period. And we ended up liquidating the remaining assets in those funds in 2025. Investors in both of these funds ended up receiving a full return of capital many, many years ago. And in December, they received a very healthy distribution due to the final sale of the assets in those respective funds, ultimately receiving nearly an 18% internal rate of return in Fund 1 and nearly a 14% internal rate of return inside of Fund 2. And we're fully going to be winding down those funds in just a couple of months. And in the story of Fund 3, which was structured for a long-term buy, improve, and hold fund, it's been consistently performing and quarterly distributions have been rolling, representing roughly a 6% cash on cash return for several years now. And we've also had a significant increase in the portfolio level equity, basically a 40% return on equity as of Q4 2025, based on the NAV, based on the net asset value. And Fund 4 has similarly been performing well, right? With consistent quarterly distributions representing roughly a 6% cash on cash return. And in a short 2 years after the launch of Fund 4, at the end of 2023, we've already achieved over $25 million in equity as a margin of safety across the 15 different assets that we've acquired inside of that particular fund. So obviously, we're proud of the track record that we've created over time. We intend to build on that inside of Fund 5. Been doing it 15 years now, started rolling out fund structures in 2017, 33 consecutive quarters of on-time distributions to all of our partners along the way. And it's actually longer than that, but we're just talking about from the time that we actually began the fund structure at the very beginning of 2017. So with that, the last thing I want to say before handing the mic over to Kevin to go over some real world results with our parking assets is this. Again, we were among the first to crack the code on buying and managing mobile home parks at scale. And we feel like we're out in front of the curve in parking as well. So rather than kind of starting with projections or with promises, we would rather start with evidence, track record, what we've actually done. We're going to show you a pattern of performance that proves the business model. So after Kevin covers the case studies, he'll then show you why we're so excited about the next deal, the Nautica deal. And with that, we'll pass the mic over to Kevin. You want to run through the individual parking case studies, Kev?
Yeah, I appreciate that, Brian. And before we do that, and before we dive into case studies in Nautica Garage, I want to take a moment, I think, and maybe just lay out the groundwork here and the foundation. So just to reiterate a lot of things you've already said, Brian. We didn't stumble into parking. We didn't test it as a side experiment, and we didn't decide to allocate capital because the thesis looked good on paper. We built conviction the right way. We own real garages. We generate real cash flow with those garages, and we've got performing assets across many, many years now. And so in today's environment where I feel discipline and downside protection are really front and center, right? Like it's the most important topic that's being discussed today. That distinction really does matter. And so I think a lot of operators that that we've spoken with over the years, they can explain maybe why parking should work, They could talk about all the, all the demand factors, the supply constraints, urban density, as you showed there with the, the picture in Houston, or, event driven demand because of a sports arena, something along those lines. But I think, very few can really point to where it's worked, where it's worked consistently across many different markets, like we're going to get into here in a few minutes. And then on top of that, under conservative underwriting assumptions, which which we practice day in, day out with every acquisition that we have here at Sunrise. So before we talk about the projections or where we believe that Nautica can go and what we can do with the performance of it, I want to start with the evidence, something that's way more important, right? Let's talk about evidence, what's real, what's actually happened, what's already occurred. And so again, to Brian's point, I'm going to walk you through a set of case studies. These are real assets that we own today with real results that will simply show you a very clear and, what I feel is a repeatable pattern of performance that's driven by our team's execution and not just storytelling, not just theory. And so with that, would love to jump in the very first example here, which is the Spectrum parking garage that's located in Charlotte, North Carolina. This is an asset that really helps solidify our confidence, in our parking strategy, and really demonstrates the durability of this model in a very high growth market. And so, we acquired this property off market, and it was one of the more complex deals that we've taken on. The garage, just give you some context here. The garage was in receivership, and it sat on a shared parcel. A shared parcel of land with an office building and a hotel, which meant that, we simply couldn't buy the garage by itself. We're not hotel guys, we're not office guys. We wanted the garage piece of it, but it wasn't that simple. And so we had to work through the complexities of legally separating it from those other two assets, creating its own, unique parcel ID and separating it from the office and the hotel. And so while we were under contract on the facility, our team also had to identify qualified buyers for the office and the hotel. We weren't allowed just to buy the garage. Even with solving the complex transaction, we still had to be able to find a buyer for the office and the hotel and basically get all three of those transactions to close simultaneously. So as you can imagine, that took quite a bit of coordination, a lot of creativity, a lot of persistence. But because of that work, because of just us persevering and pushing through some of those challenges that a lot of other folks would have walked away from, we were able to acquire that garage at a price several $1 million below its appraised value, and simply giving us a lot of margin of safety, from day one. And but then that's really the start of it. I mean, that was the buy. You do make your money on your buy, but you also make your money if you execute your plan accordingly. And so, from that point forward, we executed on the business plan. And so just some highlights of what that looked like. We adjusted pricing to match what we felt was the true Charlotte market pricing. We partnered with a number of nearby businesses to expand our monthly parker base. So we're actually attached to the Bank of America building. Truist national U.S. headquarters is 2 blocks away. Each one of those respective banks use our parking amongst a litany of other businesses in the local marketplace. So in addition to expanding our monthly parking base, we installed new technology that allowed us to better manage event parking, which is a major revenue pillar here in this garage. It's right across the street from the Spectrum Center, which is where the Charlotte Hornets play. There's large concerts, major events that take place there. In addition to that, we upgraded the aesthetics of the garage. We did concrete repair, just kind of basic stuff, but concrete repair, paint, lighting, just really things that enhance the customer experience, right? Like the overall customer experience. We want people to drive in there, feel safe, not be in a dark corner of the garage, feel safe to walk to the elevator and to come in at night, day, no matter what time of day, and just to feel, a presence of safety around them. We've now owned this for 4 full quarters, and the NOI has outperformed underwriting by roughly 12%. And I think it's important to make notice that outperformance didn't happen late in the game. It actually showed up quite early in this endeavor. And so, now you guys, you've been able to see kind of the strategy at work here in Charlotte. So would love to, again, I'd like to give you a little bit of flavor here, a couple different samples here. So would love to move on to another example where, again, execution and creativity really played a major role. And so that's with the Lourdes Garage in downtown Phoenix. Again, Brian had already kind of mentioned this a little earlier on. this is one of our pride and joys. I mean, all the parking that we bought to date has outperformed from our initial underwriting. And so, Lours is by no means an exception to that. In fact, it's absolutely crushed the game of life. And so I'll speak to that here in a few minutes. But we acquired this garage. It was off market. We went directly to the ownership group, which happened to be Invesco, one of the largest institutional real estate firms in the country. And a lot of folks assume that because a sophisticated institutional owner actually owned and managed the property, that there might not be any meaningful upside left, right? No value add component. But I tell you that couldn't be further from the truth. And honestly, I if you'd asked me that question 10 years ago, I would have felt the same way. I would have assumed that, they've got, big dollars, the most talented folks within the organization. So they are going to be the best operators in the biz, speaking to large institutional operators like an Invesco. But again, that couldn't be further from the truth. From day one, we were able to identify a really long list of opportunities on how we were going to drive value. So we renegotiated the parking management agreement, us reducing expenses. We adjusted the pricing to reflect what we felt was a true market. We leaned in really heavily on asset management, really just pushing the operator to perform at a higher standard, which hadn't been done with the prior ownership group. We also installed new technology and equipment to optimize yield management. Just like Charlotte Garage, we enhanced the physical condition. Did again concrete upgrades, repairs, paint, lighting, things of that nature. And again, just another perfect example of how execution really creates value, even when the previous ownership group was institutional. So now we've owned this asset for 9 full quarters, and the NOI has exceeded underwriting by roughly 33%. I'll say that again. That's a big number. 33% from our initial underwriting. And that's not market luck. That's not a rising tide lifts all boats. In fact, we actually bought this in a period of time that most would have argued that we were entering into a recessionary period. We bought this in 2022. And so, it was a unique time in the marketplace. Interest rates were starting to rise. And so again, one could have argued that we were entering into a recessionary period. And so really the value add component of this, again, wasn't market luck, wasn't the market, really rising the value. It was because of the operational control that we put forth. And so, this wasn't just a 1 quarter anomaly. This performance has literally been consistent across multiple years now. So, so now that we've covered 2 urban garages, again, Charlotte and Lours are very much in downtown vicinities, densely parts of the downtown core. They're in very different parts of the country, but I would love to shift to a third example here, which is, Clearwater Beach, where, tourism driven demand really, it tells a different story, but again, still reinforces, the same conclusion. And so the Clearwater Beach garage here, this was again, kind of a unique one here. This was a public-private partnership between the city of Clearwater and a local private developer. This asset, it actually wasn't on the market. It wasn't even for sale, but we were able to facilitate a relationship directly with the mayor of Clearwater and also the president of the development group that owned it. And we were able, over a period of time, consolidate full ownership of this garage. And so, despite being in one of the highest demand beach markets in the U.S., Clearwater Beach has been listed as #1 beach by, I think his name's Mr. Beach, for many, many years running, time and time again, for many decades now, it's been the #1 beach. And so, even though it's the highest demand beach in the market, pricing on this garage was well below market. The city, how they ran this garage, there was no dynamic pricing for peak times. And as you can imagine, there's busy holiday weekends, there's special events, there's, there's different times when, there's quite a higher demand for parking on, in beaches such as this. And so, I think the one thing that we probably can all agree upon, and this is one of the opportunities that we saw just earlier on in looking at this deal, is that municipalities, generally speaking, municipalities and governments, they rarely operate real estate with a strong profit motive. They're not great business people. They're just not. And so we saw that as a phenomenal opportunity here. In addition to that, though, I think one of the other big red flags for us was that the operator of this garage, so the management company that handled the day-to-day, so the city of Clearwater owned it along with this private developer. They built it, they owned it, but they had a management company that ran the day-to-day. This operator or management company was based out of Atlanta, and they didn't manage anything locally. And so again, that's always a red flag for us. Parking is very much hyper local, and so we saw a big opportunity to bring in an operator who understands local beach dynamics, the different tourism patterns that exist, the seasonality of it all, and just understands intimately what's happening there with car traffic and where people are going and heading to the beach, and what the high demand times are, and how to adjust pricing accordingly. And so one of the other big benefits that we saw here, or opportunities, is that there's also a moratorium on new parking construction on Clearwater Beach. And so supply is very much frozen while, again, demand remains strong year round. Clearwater Beach is very much a year round beach. Obviously, there's busier seasons than others, but it's very much a year round. It's not like, the northeastern beaches that essentially, boom for 4 months and then shut down for the remainder of the year. And so with that, now we've owned this asset for 16 full quarters, so roughly 4 years. And NOI has exceeded our underwriting by about 13%. And that's, consistent year after year. And so again, just, I think you see the pattern here. You see the common theme. Clearwater also shows the same durability as lowers in the Charlotte garage. And again, just, it hits home the point that when we apply our operational playbook, these results persist through multiple cycles, year after year, month after month, and it's a consistent pattern. And so now with all these 3 case studies reinforcing that same pattern, I would love to now take an opportunity to to spend some time on Nautica Garage, and again, just why we feel it fits perfectly into our overall investment strategy. I don't think I have to speak to whether or not Sunrise, our team, can operate parking, right? I think I've proven that with the last couple of case studies. We've already answered that. Again, multiple cities, multiple cycles now, multiple quarters, different environments, different locations. The real question becomes, what happens when we apply that exact same business model, the same pricing discipline, the operational systems, the same asset management intensity. What happens when we apply that to a garage that's located in one of the most expensive and parking constrained markets in the entire country? Guys, Boston, it's not just another market. I mean, it literally is one of the most supply constrained urban core markets within the US. I mean, land is scarce. Getting new entitlements is incredibly difficult, if not impossible. Construction costs are astronomical, and politically, there's very little, if no, appetite for any new structured parking. Again, to Brian's, what he made mention of earlier, they've literally removed the parking minimum requirements from new developments. They don't want new parking. They have no interest in it. They don't see the value proposition in it. And so it's a beautiful thing for us. That means, again, when you control an existing asset like Nautica, that's incredibly well located in a prime Boston submarket, you're essentially controlling something that's incredibly difficult to replicate. And, that's exactly what Nautica represents. And again, it's not a new strategy. It's the same playbook, just really applied to a new garage. And again, in one of the most supply constrained markets in the country. And really this combination is what makes this opportunity so compelling. So would love to now take the opportunity to kind of walk you through the asset itself and why we believe the submarket dynamics really create what we feel is a strong foundation for value creation for us running that same playbook over and over again. So just give some of the high level points of Nautica here. So Nautica it's a 297 space covered parking garage. It's located at 88 Constitution Road in the Charleston Navy Yard. It's, this area is one of Boston's most desirable waterfront districts. It's very much a dense, highly walkable neighborhood surrounded by its residential housing. There's institutional uses, there's medical demand, tourism traffic, and quite a bit of waterfront activity. Street parking is extremely limited. Enforcement is really strict, and structured parking options are very scarce. So there's just not many places to park here. And so simply put, the submarket is supply constrained. Again, I've spoke to this already, you can't easily build another garage here. You can't easily entitle new parking. And again, the cost to replace an asset like this today would be extraordinarily high. And so that's where it gets really interesting with this deal, is that, the current ownership group that owns the garage that we're purchasing it from, they've held this garage for a very long time. Now they've maintained the physical structure reasonably well. There's some CapEx dollars we want to put into it, as to be expected. You've got a concrete structure in a cold environment. It just, wear and tear, takes a toll over years. And so we've got some CapEx dollars that we're going to apply to this asset, but generally speaking, they've maintained the garage reasonably well. But I'd say from an operational standpoint, they've been very much complacent. The pricing has very much lagged the marketplace. There's been no sophisticated dynamic pricing strategy put into place. Monthly utilization has been fully optimized. Technology just really hasn't been leveraged to its full potential, and the asset really hasn't been actively pushed to capture the full value of this local submarket here. And so, to summarize, the location is exceptional, but the operations have been average at best. And so when you combine, again, the exceptional location with average execution, you get opportunity, right? So we don't see this as it's not a turnaround. It's not a distressed asset by any means. It's very much just a high quality garage in a prime Boston submarket where the value of the location has not yet been fully monetized. And that's exactly I think that's what you'll probably see, or what you saw with the examples I gave, right? Great location, great assets, good physical condition, but just not managed efficiently. And so again, that's really where our operating discipline comes into play and allows us to create meaningful upside for our partners. And so because Nautica is already an operating garage, again, we've got established demand there. We can move directly into execution, our playbook here. So a couple of things that we intend to do right out of the gate. We're going to go ahead and refine the hourly rates. Again, they're not at market, and the demand is present already. We're going to improve monthly parker utilization. We're going to expand online bookings. They don't really have a good online booking system, and in a city like Boston, quite a high percentage of parking, especially transient, uses the various online booking resources. And so they don't really have a good system for that. So we're going to expand the online booking presence of this garage. We're going to integrate upgraded technology, renegotiate some vendor contracts, streamline payroll. We found that the payroll is about double of what it should be for this garage. Again, complacency at its best. We're going to really push hard on the asset management side of it. Again, this is no different than the other ones. It's the same playbook for the most part that, again, really provided meaningful performance in Charlotte, Phoenix, and Clearwater. Another thing I'd like to speak to here is that, we really, we look at a lot of parking. We look at a lot of parking to find opportunities that check all of our boxes. And one of the big boxes that have to be checked is we want to know that we've got a wide variety of demand drivers. What we don't have an interest in is a parking garage that's tied to, call it, one or two demand drivers, maybe an office building and one other demand driver, to where if one of them goes away or one of them suffers, then ultimately the performance of the garage would suffer significantly. We want to know that we've got a wide variety. And the wide variety to us means at least 5 unique demand drivers across the board, meaning that if one should suffer at some point in time, we've got 4 others to support it. And so with that, Nautica, it really checks the boxes of all 5 demand drivers. First big one being institutional demand from the MGH Institute of Health Professions, large medical facility, just literally right around the corner from the Nautica garage. On top of that, we've got the second demand driver, which is residential demand. So if you can see from the various pictures that we've had, not on this particular slide, but there's a 117 unit Nautica condominium complex that is built around this garage. And they have no parking. The only parking they have is the garage. So they don't have their own dedicated private parking. Their parking is in the garage. And so they are required to have, if they have a vehicle, they are required to park in the Nautica condominium garage. The third demand driver is tourism demand. As you can see, it's in the waterfront district. So there's quite a bit of historic attractions there at the waterfront. There's, events and festivals that happen in the summertime. And so just quite a bit of folks that are coming and going in that area. The fourth demand driver is healthcare. So we've got a litany of surrounding medical uses that folks park in the garage for. And then the fifth one is the maritime and waterfront demand. Again, we've got a ferry service there. So folks are parking to take the ferry across the waterway there. We've got marina users. We've got a large marina, and also a lot of seasonal activity. As I mentioned, you've got festivals and concerts and things of that nature that happen there in the waterfront. And so for us, these 5 independent demand streams really create what we feel are balanced weekday, weekend, and year-round utilization for the garage. This is the type of demand profile that really supports durable long-term cash flow. Now, I'd love to move on here and talk about maybe some of the economics of the garage here. So we're acquiring the asset for $12.85 million, which is very much a clean and supportable purchase price. It's backed by a third-party appraisal. Again, as I'd mentioned, this is by no means a distressed situation. Simply put, it's really just a disciplined arm's length acquisition, and again, one of the most supply constrained parking markets in the country. And we're buying it from an operator, from an owner that's been fairly complacent over the last couple of decades. Now, from a capital structure standpoint, this is something we always do, but this is no different here. We've intentionally kept this very conservative. We're very conservative on debt terms that we put on properties. We never over leverage. We always get fixed rate debt. And so this is no different. We're financing the deal at a 65% loan to value. And again, this very much provides a meaningful equity cushion right out of the gate and quite a bit of downside protection. The debt terms as well are quite strong and again, very predictable because we've got fixed rate debt. So 5.68% fixed rate interest rate. It's a 5-year term. We do have 24 months of interest only. And then it's all laid out over a 30-year amortization schedule. So, the 2 years, how we look at this is that the 2 years of interest only really allows us to implement our operational improvements immediately while maximizing the earlier years for cash flow. And then after that, the 30-year amortization really allows us to keep payments manageable and preserves long-term flexibility. Again, we don't go aggressive with leverage. We're very conservative. We're very disciplined when it comes to structuring our capital stack, not just on acquisitions like this, but on pretty much everything that we do. It's consistent across the board. Now let's talk about what happens after we pull the operational levers. I already spoke to what they were going to be, and so once we optimize the pricing, improve the monthly utilization, better technology, all those things, and just really actively manage the asset the same way that we've done in Charlotte, Phoenix, and Clearwater. We're targeting the following by the end of year 4. We're targeting the 14.5% deal level IRR, 2.1 equity multiple, and an 8.2% cash on cash return. So, guys, let that sink in for a second. These are very much exceptional returns under any circumstances, but to generate them on what we feel is a stabilized income-producing core garage in Boston, one of the most expensive and parking constrained cities in America, this is extremely rare. And what makes this so compelling is that these returns, they're not driven by any speculation by any means. I mean, it's conservative leverage. We've got a pretty clear operational execution plan in place. We've got supply constraints that are there. They're real. Demand is real. And again, we're very disciplined with our underwriting. We're very conservative on the front end. As you can see with the prior examples I gave, we've exceeded underwriting and pro forma time and time again, year after year, on every asset that we've owned. And so, this is exactly the kind of deal that we want in Fund 5. Again, we want the durable cash flow, something that's really positioned in a submarket where long-term demand and relevance is, it's virtually guaranteed. And so with that, I appreciate everyone's time. Appreciate you giving me the opportunity to kind of walk through some of the, the case studies, examples, but also, deep dive into Nautica. And so with that, I'm going to turn it back over to Brian and he'll take some time to walk you through how Nautica integrates into the, the broader portfolio and also what this really means for Fund 5 moving forward. So with that, Brian.
Love every bit of it, Kevin. I tell you what, this is one that I'm personally very excited about. Boston is a phenomenal city, period, and a story. The museum, it's the USS Constitution Museum. So if anybody's familiar with Old Ironsides, the idea and the concept and the terminology Old Ironsides, that ship is literally on display. And the garage that we have is one of the demand drivers is the USS Constitution Museum there. So again, it's a beautiful, beautiful asset. Love every bit of it. And what we're really buying is an unbelievably strong set of cash flows over many, 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 many decades, with the opportunity to increase those cash flows immediately after closing the transaction. So extremely excited about it. It's an ideal buy and hold asset because, again, you're getting really strong in-place cash flows right out of the gate with the opportunity to increase them over time. And from our perspective, it just pairs very well with the pre-existing Fund 5 assets. Again, operating in a beautiful growth and income structure, the amount of income we're going to be deriving from this, we're very, very excited about as we progress. When you look at mobile home parks and parking, it's a beautiful pair that provides exceptional growth and income over long periods of time that can generate cash flow and build legacy wealth in a tax efficient manner. That's what I'm trying to do for my family. That's what Kevin's trying to do for his family. And we're going to help as many people as possible do that as we can along the way. But in the interest of no man left behind, again, inside of this particular fund, we're not only buying parking, but we're also buying mobile home parks. So we'll do a zip through flyover of the macroeconomics of mobile home parks in the interest of no man left behind. What this really shows, again, we're going to talk about supply and demand in mobile home parks. What this really shows is a growing affordability gap in housing. Nearly half of renter households are cost burdened, and millions of families are looking for housing that fits their budget without sacrificing stability. And manufactured housing fits that role. For many residents, it's not, temporary housing. It's a long-term, attainable homeownership structure with lower monthly costs, very strong communities, and very predictable living expenses. That's why the demand is exceptionally high and remains so consistent over long periods of time. We're not relying on trends, right? Quick fix and flip style trends. We're serving a permanent need in the housing ecosystem. It's this is the way that we're making a dent in the affordable housing crisis, right? That's our mission. And when, housing meets a real ongoing need, occupancy tend to stay really, really high across all the different economic cycles, and that's what we've seen play out. So jumping into the supply side of the house, looking at the numbers, we pay tens of thousands of dollars every single year to help us stay informed and skate where the puck is going with institutional data to keep our finger on the pulse and make the best decisions on behalf of all of our partners and families inside of the fund. So there's no fudging the numbers here, guys. These numbers are literally from the second quarter of 2025, the newest data that we possibly have, and they go out to 2028 as far as Green Street is willing to project. This chart shows that through 2028, there is still no new supply of mobile home parks likely coming online. So the demand for the product continues to go up, especially during recessions, which ensures fantastic recession resistance for the asset class. And there's no new supply coming online. And that creates a massive moat in the industry. And it's why guys like Warren Buffett and Sam Zell are so heavily invested in the asset class. Massive demand, no new supply creates ridiculously profound long-term same-store NOI growth. And that's what you see here. When you combine the rising affordability pressure with almost no new supply, you get a widening gap between demand and availability. And that's the opportunity. That's the opportunity. Manufactured housing is not dependent on appreciation assumptions. It's supported by fundamentals, cold, hard cash flow over long periods of time. More people need affordable housing every single year, and fewer communities are being built. Over time, that naturally supports occupancy, income growth, and long-term value. We're trying to provide as much affordable housing to the marketplace as we possibly can. There's not enough of it. We can't keep up it. We're trying to make a dent, but we literally can't solve that affordable housing crisis ourselves. And ultimately, from an economic perspective, it means that the asset class has historically outperformed every single other asset class. At the end of the day, if pressed to choose only one reason why mobile home parks, I would say that mobile home parks and parking provide the best risk-adjusted returns out of any real estate niche. A recent webinar from Green Street Advisors reported that not only are the long-term returns the highest, but there's also near-term upside. So honing in on the first one, why mobile home parks? It's not just cap rate compression. The impressive total returns delivered by non-core property sectors have been partially attributed to outsized cap rate compression. More importantly, however, has been the impressive performance at the property level. And that perfect harmony of these two asset classes has been the foundation of several of our outperforming funds over time. So let's dive into what we've been able to achieve thus far with the power of parking and mobile home park investing. And it should be noted that this exceptional asset is entering a fund that's already providing strong cash flow and millions in day one equity. The train has already left the station. It is rolling down the tracks, and we're gaining momentum every single day. Fund 5 already owns 6 wonderful performing mobile home parks, all of them providing strong cash flow, well suited for our light value add approach, and representing the kinds of assets that we want to hold for decades to come. So here's how Fund 5 works in a nutshell, super high flyover. As I mentioned earlier, we operate a buy, improve, refinance, and hold strategy. Investor capital is returned via refinance proceeds as opposed to selling the assets. And that tax efficient wealth building strategy, it minimizes investor risk and it maximizes the velocity of money. And once the original investment has been returned, investors get all the chips off the table, they retain their equity ownership in the fund, and they enjoy ongoing quarterly distributions and lifetime cash flow. The first step in our process is always to protect the capital first. That's number one. Rule number one, don't lose money. Rule number two, don't forget rule number one. So we always focus on Charlie Munger's philosophy of invert, always invert. We always, as opposed to thinking about how much money can we make, we think about how can I lose all of my money and mitigate all of the risks, all of the ways in which we can lose all of our respective money, protecting the downside first, period, end of story. And then we focus first on return of investment before we ever focus on return on investment. But once we've done that, once we've bought assets that are recession resistant, buy with a margin of safety, we've diversified, we've optimized for tax efficiency along the way, we've protected the capital, then we seek to maximize returns along the way, build lifetime cash flow, drive the best after-tax free cash flow that we possibly can along the way, try to drive the best risk-adjusted returns in the marketplace, and have an asset class that just performs wonderfully in inflationary environments. The asset class obviously does exceptionally well during periods of inflation because, we largely have the luxury of passing along the additional cost of inflation onto the consumer. And we're buying a package of a group of packaged commodities, right? All of the different properties are made of bricks and sticks and copper and lumber, and all these commodities grow in value over time due to inflation. They retain their value. Here's a Fund 5 overview. Look, we've already acquired 6 phenomenal mobile home parks inside of Fund 5 prior to adding the Nautica Garage. These are going to pair exceptionally well inside of the growth and income fund. These 6 different individual assets, roughly $31 million of transactions in the mobile home park sector, we're operating the same exact proven playbook, the same rinse and repeat business model that we've operated now to great effect for 15 years inside of the mobile home park sector. So the train has already left the station. It's rolling down the tracks, and we're adding the Nautica deal to this fund, which will pair very, very well with the pre-existing assets that we already have inside of Fund 5. So moving into the actual investment details, we'll hit the high points of Fund 5. We have a max offering amount of $50 million. There's a minimum check size of $100,000. In terms of the preferred return, you have the luxury of picking your tier. If you contribute $100,000 to $249,000, you'll earn an 8% preferred return. If you move from $250K to $999,000, you unlock a 9% preferred return. And if you invest $1 million or greater, or if you're a legacy investor, a previous partner in a prior fund, you'll step straight into a 10% preferred return rate. As far as the cash flow priority and the equity split, investors receive 100% of net operating cash flows until the full return of capital and preferred return have been received. And then after that, there's a profit that flows 70% to the investors and 30% to Sunrise. We're targeting somewhere between 14 and 18% annualized in terms of returns, with a 6 to 8% average cash on cash return along the way. Distributions are paid quarterly. We expect to start the Fund 5 distributions following the fourth quarter of 2026. So the first distribution will hit the accounts of investors, limited partners, on roughly January 15th, 2027. We always like to build a really solid financial foundation inside of the fund prior to commencing making outbound distributions inside of the particular offering. It's a long-term buy and hold fund over time. And this is a rolling close fund. Because it's a rolling close fund, subscriptions are open now, and units, they're allocated on a first funded basis. That is the snapshot in a nutshell. Strong cash flow today, meaningful upside tomorrow, and full alignment between Sunrise and our partners. And just speaking about the alignment of interest between Sunrise and all of our partners inside of this particular fund, Kevin and I have literally invested millions of dollars in our personal capital alongside of all of our partners inside of Fund 5 along the way here. So again, we do our best to ensure that we keep a true alignment of interest along the way, and that capital is invested at terms that are no better than the terms that are offered to our partners along the way. Again, one of the things that our partners really have historically appreciated about us is the way in which we don't just talk about alignment, but we actually build it into the structure. And with Fund 5, that alignment shows up through not only the capital that we've invested alongside of partners, but also through our early investor bonus. Of the 20% early bonus tier available to the first $10 million of capital inside of the fund, it filled up within the first 2 weeks of the launch. The 15% tranche, it went shortly thereafter, and we're now in the 10% bonus tier. And based on the current momentum that we have inside of the fund, we expect this allocation to move quickly as well. And from there, the bonus scales down gradually. Obviously moves to 5% after this until we've ultimately reached that $50 million raised. Now, if you've been tracking Sunrise for a while now, or if you've invested with us before, you know that this is a window where acting early matters most. Early capital doesn't just start working sooner, it captures more of the upside as these communities stabilize, as they continue to appreciate, and they strengthen Fund 5's long-term income engine. And with that, I am proud to officially share that Sunrise's Growth and Income Fund 5 is open for investment. The fund builds directly on our track record. We've had 33 consecutive quarters of on-time distributions to partners, no capital calls, zero principal losses, over $1 billion in total transactions. Fund 5 is designed to deliver the same consistency, scalability, and security that our partners have come to expect from our shop. And that means investors can access immediate cash flow, tax-advantaged income, and long-term equity growth. As always, our focus is simple: protect the downside, grow capital responsibly, and align every single decision that we make with our investor success over the long term. And if you're ready to take the next step, we'd be honored to have you join us in Fund 5. Your capital will go to work with the acquisition of the Nautica parking facility, earning income, creating stability, and building legacy wealth for many years to come. And you can take the first step by scanning a QR code here. If you want to jump on Talk Shop, have some questions, feel free to scan the QR code on the left, schedule a call. We welcome the opportunity to talk shop with you. And if you're interested in moving forward with a soft commitment, the QR code on the right will take you to the deal room, provide you all the respective access necessary to take the next actionable step to move forward inside of the fund. We look forward to partnering with you guys here in Fund 5. We're obviously very, very proud of what we've been able to accomplish thus far, but we're never satisfied. And we look forward to the next step in our journey together.